While we're discussing deductions, I would be remiss if I didn't mention retirement contributions. It's not an itemized deduction, and it can be coupled with the standard deduction. And it's really one of the best tools for reducing your tax burden today without giving the money to someone else. If you're an employee, it's too late to really affect your 2024 taxes, but you can plan ahead for 2025 by contributing a portion of your income to your employer's retirement plan each pay period. It comes out a little easier when it's broken down into each pay period. And if you're under age 50, you can contribute up to 23,500. There are some limitations that are tied to your earnings, but the maximum you can contribute is 23,500 to your employer's qualified retirement plan. This often also triggers a match from your employer sometimes. So it's a good thing to consider. Those between 50 and 59 can contribute up to 31,000, and those 60 to 63 can contribute up to 34,750. So there's quite a bit of money that you can take out of your taxable income because this amount is excluded from the income reported on your W-2 for income tax purposes. If you're self-employed, you can still cash in on some of this retirement contribution, and you can still do it for 2024. So depending on what type of plan you have and what your business structure is, you can make contributions as late as October 15th of 2025 and still have them count for 2024. If you qualify for a traditional IRA contribution deduction, you can still make payments until April 15th of 2025 and have it count for 2024. So this is one of the rare areas that we can actually do something after year end to affect the prior year's tax situation. Any of these plans will ultimately work in the same way, provided they're a qualified plan and do not have a Roth designation. You're going to defer income tax on the contribution amount until the funds are withdrawn from the retirement plan. So you're keeping the money for your future use while reducing your current tax burden. The downside, of course, there's always a downside, is that you may not have immediate access to that money. If you withdraw it before you're age 59 and a half, you will not only pay income taxes on that amount, but you'll also pay a 10% federal penalty for early withdrawal. So lots of things to consider here, but again, retirement deductions are a great way to save on your current tax burden and plan for your future.